Hi there, I'm Edward Kalstian, founder of EKH Capital, where we look for market-beating stocks for the long run. This video is part of my 5-part series explaining the 5 key factors I use when analyzing companies. These are the pillars of my investing strategy. Today, we're diving into key factor 3, healthy financials. A company can have strong returns and good growth, but if it's drowning in debt, all of that can vanish in a downturn. Financial strength is about resilience. It's what allows companies to weather recessions, invest in opportunities, and avoid being forced into bad decisions when times get tough. As Warren Buffett once said, you only find out who's swimming naked when the tide goes out. In other words, a weak balance sheet gets exposed in bad times. Here are the metrics I look at. First up, cash reserves. Cash on the balance sheet provides optionality. It lets companies invest or acquire when competitors are forced to pull back. Next up, debt to equity ratio. This shows how much debt versus equity a company uses to finance operations. In most industries, under 1 is conservative, though capital-heavy sectors like utilities can carry more, while asset-light tech firms should stay lower. And finally, free cash flow versus debt. This tells us how much of a company's debt could be repaid from just 1 year of free cash flow. As a rule of thumb, I look for at least 10%. That means the company could, in theory, pay down 10% of its debt annually, clearing it in about a decade. That's a bare minimum for flexibility, and higher levels are even better. Cyclical industries like industrials or energy need this cushion more than stable sectors like utilities. Legendary investors like Warren Buffett and Howard Marks remind us that strong companies should repay debt from internal cash flow, not rely on capital markets. Together, these ratios tell me if the company can fund growth internally or if it leans too much on borrowing. Now let's take ABB as an example. ABB holds about $5.6 billion in cash and short-term investments compared to $8.1 billion in total debt. That means cash alone can't fully cover debt, but it does give the company meaningful flexibility to invest and act strategically. More importantly, ABB has been strengthening its balance sheet. Its debt-to-equity ratio now stands at 0.5, down from 0.7 in 2022, a clear sign of improvement over the past 2 years. And here's the kicker. ABB's free cash flow covers nearly 47% of its total debt in just 1 year, far above my 10% benchmark. That kind of coverage shows real financial resilience. This strength gives ABB room to reinvest, reward shareholders, and navigate downturns without stress. By contrast, over-leveraged companies often end up forced to sell assets, slash dividends, or issue stock at the worst possible times, destroying shareholder value. Evaluating a balance sheet across many companies can get complex. That's why I use Fiscal to quickly assess debt levels, cash flows, and debt coverage ratios. If you want to make your research process more efficient, check out Fiscal with my affiliate link below. You'll get 15% off at no extra cost to you. At EKH Capital, I want companies that can compound not just in good times, but through cycles. As Peter Lynch said, the real winners are companies that can finance growth from internal cash flow. That's why healthy financials is key factor 3 in my investing framework. It gives us confidence the company can sustain returns and growth without taking on dangerous risks. Financial strength matters because it protects against downturns, gives flexibility to reinvest in opportunities, and preserves shareholder value long term. Always remember, great businesses don't just grow, they endure. That's key factor 3 in my investing framework. Next time we'll move to key factor 4, valuation. How to determine if a great company is fairly priced. If you found this helpful, please hit like and subscribe, and let me know in the comments, how much weight do you give to a company's debt when analyzing investments? Thanks for watching, and I'll see you in the next one.